I've been around business acquisitions for about 17 years, and from time to time, I see what I'm going to call predatory investors. Okay, that are trying to tilt business acquisition into their favor and maybe take advantage of a potential buyer. Okay, today I want to talk about how to identify when that's happening and how to navigate through it. My name is Walker Dybel. I am the Wall Street Journal best-selling author of Buy Then Build and creator of the Acquisition Lab. What I want to start with is what I call the 5 forces of acquisition entrepreneurship, 5 forces of AE model, okay? And it works kind of like this. So you've got a business that you're going to buy, okay? Here's the business, and you have, this upside potential, okay? Upside potential of a gain, and then you have this downside risk at play, right? And then you have an input, okay, an operational input, which is an investment, usually of dollars, okay? And then you have a output, which is hopefully, right, cash flow, okay? And then of course, while you're operating the business, you have time, okay? So the operational force that's going on here, okay, is you have money being input, you have time being input, and then you have cash flow coming out, okay? Cash flow. And so this cash flow, as you're operating the business, okay, comes back and pays down the loan, right, which is really the risk side, and starts to lift with the equity buildup towards your upside gain and your return on investment in it. Operational efficiencies, as you're running it, operational excellence will cause the upside gain of this business in order to take effect, right? That's that sort of wind that you're putting time and money into it. And so some of this cash flow might be coming back, hopefully to pay the operator, which may be you, and also to fuel business investments going on, right? Working capital, capital expenditures, ongoing investments in growth, and also you, okay? So when you are a true acquisition entrepreneur, okay, you're putting your own money in, you're putting your own time in, okay? You get all of the cash flow, you take on all of the risk, and you get all of the upside. And this is really the beauty of the acquisition entrepreneurship model that we talk about so frequently. But here's what happens, okay? Let's just look at this in terms of what are the things that we want, okay? What we want is we want the cash flow, right? And we want the upside potential, the upside return of this investment, okay? We don't necessarily want, or we want to minimize, okay, the dollars that we invest into the deal. We want to minimize the risk that we're taking on in order to execute this. And frankly, if we're honest with each other, we all just kind of want to sit on the beach or like own a bunch of businesses. And so putting the money into the deal, putting the time into the deal, or taking on risk are the sort of inputs and downside of this whole transaction, okay? And what we want to do is obviously maximize the cash flow and the upside, okay? That's the beauty of this model. Now, here's the thing. What I'm going to say is that because we can take these two things, let's use red. We can draw a dotted line cutting off in between the good things and the bad things of this deal, okay? So in this deal, the things that, again, AE is all about putting in time and money, taking responsibility, and making this whole thing your own, okay? But now we're gonna bring in a partner, we're gonna bring in an investor, we're gonna do all of these other things, okay? And so as we start to bring in other people to make this deal happen, what everyone's trying to maximize is this and this, okay? So if you are talking with an investor who is forcing an imbalance, where you are being forced into inputs and risk, while they take the lion's share of upside and cash flow, that is what I'm gonna call a predatory investor. Okay. Now there's 2 ways 2 examples I'm gonna give you. Okay. Okay, so you're about to do a deal. It's an SBA deal. And what we have is we're going to say, let's just use $1 million as an example. Okay, so this transaction is going to be $1 million that we need to pay the seller at closing, okay? Or in total, whatever it is, okay? And by using an SBA loan, we're able to put in as little as 10% into this. So let's call that 100,000, okay? 100,000. And then this additional 900,000, all right, comes from a personally guaranteed SBA loan, okay? And so we get the money, as the entrepreneur, we get the money in order to do this, okay? But what we need to come up with is this $100,000, okay? So what happens is that in example number one, and this is the most common, is that the predatory investor will say, well, look, this is not a $1 million enterprise value deal. This is a $100,000 investment. And so they know as long as they own less than 20% of the business, that they don't actually have to sign the personal guarantee on the deal. And what that means is that they can say, well, look, I'm going to invest 19% of the cash value, so $19,000, while you put in $81,000. Let's loosely call it 80-20 rule, right? Then we will go ahead and own 19% of the business, okay? And so they're basically getting a 19% ownership stake at the cash value. And the right thing to do, of course, is to base it on enterprise value. Okay, now I do believe that investors should get a step up because of the operational risk. We've done another video on that. I'm not going to go into it. The point is do not let investors invest at the cash value. Okay, because what happens is that you are taking on outsized risk. You are putting in outsized investment. You are putting in outsized time. Okay, yeah, they're participating in the upside, which is great, but they're not participating in any of these other things. Okay, now here's the real trick: is usually there's some kind of cash flow demand from a predatory investor, right? This is someone who's enthusiastic, they're energetic, they have all these claims. They've bought a lot of businesses, they've built teams, they've done all these things, like all the attributes of success, right? Maybe a little hard at diligence, maybe a little foggy on the specifics, right? But the thing is you can see they're a mover and the shaker, and they've done all this stuff, and so they might come to you with a plan. They might say, listen, I've built a team of marketing experts dedicated specifically towards small and medium-sized business. We're going to get you in here, okay? And you're going to make the investment. You're going to put in all the time. And what's going to happen is, of course, we're going to allow for some of this cash flow to go back to, pay your debt down, your debt. But we're going to offer these services to you, actually. And so we're going to go ahead and draw cash flow out of this, right? So what they're doing is they're saying, you put in the investment, you put in the time, you take on the risk, all right? Remember that red line we had? Let's draw that again. You put in, you take on all of this. We'll go ahead and provide services in exchange for this cash flow, okay? And then we get to participate in the upside as well, okay? That is something that is an imbalance, okay, in the five forces. And that's why I think that that's a predatory sort of situation. Another example might be, hey, tell you what, you go ahead and put in all the investment, and you go ahead and put in all of the time, okay? And look, the last example, they put a little investment in and got a lot of the cash flow and some of the upside gain. In this example, they might say, listen, we'll go ahead and take the loan, okay? So we'll participate in the risk, but we'll get the lion's share of the upside, and we control the cash flow because it's paying down our risk, right? And so this is where they get an acquisition entrepreneur and turn them into an investor, right? And they say, look, you're an investor and you're going to put your time in, and we'll go ahead and take the lion's share of these things. So again, it's all about understanding the five forces and understanding, is there an imbalance between the positives of AE and the drawbacks of AE, okay? Listen, if you're interested in buying a business in the next 6 to 24 months, please consider the Acquisition Lab. After the success of Buy Then Build, it was critical to me to go ahead and build the premier accelerator around helping people acquire their first business. We're a vetted community. We have about 25% of applications get accepted into our program. We have 500 members. We've exceeded 200 million in member acquisitions. We've got a really good member to acquisition rate, and it's anchored in world-class education, diamond method coaching, tools, resources, and supplier network, as well as a vetted community. Thanks so much. Check it out at acquisitionlab.com. See you on the inside.